Picture this. You wake up one morning to the familiar sound of your alarm clock, but something feels off. As you stumble into the kitchen, you reach for your favorite cereal, only to find that the box is half empty. Puzzled, you turn on the tap to fill your glass with refreshing water, but only a weak trickle emerges. You glance at your smartphone, anticipating a full battery to start your day, but instead, you're greeted with a flashing low-power warning. These everyday scenarios, though seemingly unrelated, share a common thread. They serve as analogies to the slow creep of a recession into our lives. Just as the cereal gradually depletes, the water flow weakens, and the smartphone loses its charge, an impending recession manifests itself through subtle yet impactful changes in the economy. It's like a pervasive presence, slowly seeping into various aspects of our lives, often without immediate notice. For today's video, let us know what Ed Hyman means as he starts to see a recession by summer. But wait, there's more. According to him, it's not a mere recession, but something that is slow-paced. Ed Hyman is a prominent economist and investment strategist. He is widely recognized as one of Wall Street's most respected economists and is renowned for his expertise in economic forecasting. So, anyways, the first thing that Ed Hyman noticed is that the economy is slowly slowing despite it being strong.
Right now, the economy is pretty strong, but I think it's slowly slowing, and will keep slowing. And as I mentioned, you know when it's impacting when you get a financial crisis.
It is evident when there have been economic crises, which is what's actually happening right now. For him, there had been a tightening in central banks lately.
But then I've also found that if we're tightening and other central banks aren't tightening, it's not so bad. But if we're tightening and other central banks are tightening, it makes our tightening much more aggressive on the economy.
What's more to it is the fact that this can be felt by people for over a year or so. But what does the concept presented by Hyman all about? How can a tightening contribute to a slow recession? Well, friends, here's how. Imagine a group of banks having a little dance-off to see who can tighten their belts the most. If only one bank decides to tighten their belt while the others keep theirs loose, it's not a big deal. It's like that one friend at a party who decides to go on a diet while everyone else is devouring pizza. It may be good for them, but it doesn't really affect the overall party vibe. However, things get a bit more intense when all the banks decide to tighten their belts simultaneously. It's like a synchronized dance routine where everyone suddenly starts pulling their belts tighter and tighter. Now, imagine that you're the one who was already wearing a slightly tight belt, and suddenly everyone around you starts tightening theirs as well. It feels like you're being squeezed even tighter. That's how aggressive tightening by multiple central banks can impact the economy. Now, how does this scenario impact individuals and businesses alike? Well, friends, central bank tightening often involves raising interest rates, making borrowing money more expensive. For borrowers, such as individuals seeking mortgages, car loans, or personal loans, higher interest rates can put a strain on their finances. Imagine you were planning to buy your dream home, but suddenly interest rates soar. It might force you to reconsider your plans, potentially leading to a decline in housing demand. Similarly, the cost of borrowing for businesses may increase, impacting their ability to expand, invest, and create jobs. Reduced borrowing can ultimately limit the spending capacity of individuals and businesses, leading to a decrease in consumption and investment, thus exacerbating the effects of a slow recession. Central bank tightening can also affect financial institutions. Banks and other lending institutions rely on borrowing at low interest rates to lend money to consumers and businesses. When interest rates rise, the cost of borrowing for financial institutions increases, potentially squeezing their profit margins. Moreover, tighter monetary policies can impact the availability of credit in the economy. As central banks tighten, they may implement stricter lending standards, making it more challenging for individuals and businesses to access credit. This reduced credit availability can hinder economic activity and slow down the overall growth of the financial sector. Also, higher interest rates can make fixed income investments, such as bonds, more attractive compared to stocks. Investors may reallocate their portfolios to reduce exposure to stocks, which could lead to a decline in stock prices. Moreover, tighter monetary policies can signal a more cautious approach from central banks, potentially dampening investor confidence and increasing market volatility. Uncertainty in the stock market can impact the wealth of individuals and discourage investment, further hampering economic growth during a slow recession. You might also be wondering why such tightening in central banks has occurred, in this, according to Ed Hyman, rooted from him seeing an inverted curve yield.
And the money supply is now contracting, and it's associated with the banking crisis. Bank deposits come down. And then somewhere along the line, I picked up the yield curve. And as you know, it's significantly inverted.
When Ed Hyman mentioned seeing an inverted yield curve, he was referring to a phenomenon in the bond market that is often seen as a potential indicator of an upcoming economic downturn, including a slow recession. In a normal yield curve, longer-term bonds tend to have higher yields or interest rates compared to shorter-term bonds. This makes sense, as investors typically expect higher compensation for tying up their money for a longer duration. It's like asking for a bonus dessert after patiently enduring a long 3-course meal. They're not just going to settle for any old return. They want a sweeter deal because time is money, and they want their money to grow in style. In contrast, an inverted yield curve occurs when shorter-term bonds have higher yields than longer-term bonds. It is a situation where interest rates on long-term debt instruments, such as 10-year Treasury bonds, are lower than those on short-term debt instruments, such as 2-year Treasury bonds. The inversion of the yield curve is significant because it goes against the typical expectation of higher yields for longer-term investments. It suggests that investors have a pessimistic outlook on the future economy, anticipating lower interest rates and potentially slower economic growth ahead. The inverted yield curve is closely monitored by economists and market analysts because historically it has often preceded economic downturns, including recessions. It has served as a reliable but not infallible warning sign. When the yield curve inverts, it implies that investors are seeking the perceived safety of long-term bonds, anticipating a possible economic slowdown or even a contraction. They are willing to accept lower yields in the long run to safeguard their investments. The implications of an inverted yield curve are multifaceted. Firstly, it indicates a potential tightening of financial conditions, which I just had discussed early on, as investors flock to long-term bonds, which can lead to a decrease in borrowing and lending activity. This tightening can dampen consumer spending, business investment, and overall economic activity, contributing to a slow recession. Secondly, it can affect the profitability of banks and financial institutions. Inverted yield curves can squeeze banks' net interest margins, as they typically borrow at short-term rates and lend at longer-term rates. Further, it is crucial for individuals, businesses, and policymakers to be aware of these factors and take steps to prepare for potential economic challenges. Stay informed, build emergency savings, evaluate debt and financial commitments, and diversify investments if you have. This stance has been agreed by an audience where Ed Hyman was interviewed on Bloomberg television, saying, "Recessions are an unavoidable part of the economic cycle. All you can do is prepare for them and plan accordingly." This is also what other people from the audience have said, saying it is not new that a lot of storms are brewing in the United States, and so his concern is how to maximize his savings/retirement fund. What about you? Are you also preparing for the worst scenario in our economy? Share your thoughts in the comments section below. Don't forget to like, share, and subscribe to Finance Zoo channel. I'll see you in the next video.